What's up, YouTube? In this video, we're going to talk about a company that most of us have probably never heard of, and that is Constellation Software, ticker symbol CSU. Now, if full disclosure, real quick, if you do have interest in wanting to buy this company, you might have to message your broker and figure out if there is a ticker that your broker uses for this specific company because, first of all, it's out of state and it's also off the beaten path for typical stocks. Year to date, company is up 32.9% over the course of 1 year, 45.2%. Constellation Software has never, the market's never challenged this company. Obviously, in the last 10 years, CSU is up 1,500%. The market's only up 141%. So it's got a very good, strong track record of just growth, especially in the stock price, especially compared to the market. CSU, what they do is they buy companies. That's like almost all they do. They buy out these companies. They've got a minimum and a maximum for like a buy range for certain companies. And they also have to be vertical market software businesses in Canada, United States, United Kingdom, and rest of Europe. The company's industry-specific software business provides specialized and mission-critical software solutions. So this company goes around and finds these vertical market software businesses and tries to buy them, right? But not just buy them just to buy them, but make sure that it's got a good growth potential behind it and a good business model. They don't just buy every single business that comes about, but they do try and buy these businesses that they like and that meets their certain criteria that they have. And when it meets it, then they try to make a deal on it. So for instance, they have one coming up here soon that's potentially going to happen, and that is they're going to potentially buy Optimal Blue from Black Knight. So right now we can see they're going to buy it for about 700 mil, and they're going to use 200 million cash, and then they're going to use $500 million as an IOU to Black Knight. They're buying this for a potential discount or beneath market value. So Black Knight bought Optimal Blue for $1.8 billion. Now, I'm not real sure if that means it's 60% of $1.8 billion or they paid $1.8 billion. But either way, if it's 60%, they still paid $1 billion for the thing. And we know that Optimal Blue is going to get bought by Constellation Software for just $700 million. So you could look at it both ways, as either they're finding good deals on good businesses or they're potentially buying bad businesses for a cheaper price, right, than what they were originally paid for. But based on their track record, I'm going to say option one is more likely because Black Knight has to sell Optimal Blue in order to gain regulatory clearance for ICE proposed acquisition of Black Knight. So Black Knight has to sell Optimal Blue in order for ICE to purchase Black Knight. So it seems like they're backed up in a corner. They want to make this deal happen, but in order for this deal to happen, they have to get rid of this. And since they have to get rid of it, they're probably going to sell it for a discount, which it looks like they're doing. And so that's where Constellation Software comes into play and picks this up for a discount or a deal, and they just add it to their portfolio of businesses. Over the course of many years, this company has purchased about 600 different businesses and is split up into 6 different operating segments. And we can see here's all their operating segments that they have. They've got all 6 different operating segments right here. So when Constellation does acquire these businesses, they never sell a business. And the CEO, Mark Leonard here, once sold a business in the early days of Constellation Software and is still regretting it. And for family-run businesses, which is what they kind of go for, is they want to find these businesses that the owners, the originators, are still part of, because then it makes the business, when they're still part of that business, they feel going to work harder to maintain this business and grow the business. Buying it, family run businesses, they don't want to be sold to a different owner every few years or being optimized for high selling price by drastic cost reduction strategies. So Mark Leonard is following a similar strategy as what Warren Buffett and Charlie Munger do. They acquire businesses, will remain as independent as possible, and we must assume that most founders and leaders appreciate being able to remain in control of their own business. So they're going to buy your company, but the original founders are still going to be in control. So basically, they're going to buy out the owner, but the owner is still in charge of the business. So another really big key component to this business is obviously the people that run it. So such as Mark Leonard, the CEO. So he's been the president of CSI for 20 years. Okay, so he's looking to wind down and potentially retire in the near future. So what he's asked is the board to reduce his salary to zero, because what he wants to do now, instead of traveling, what he has done in the past, he's traditionally traveled with economy tickets and stayed in modest hotels because he wasn't happy freeloading on the CSI shareholders, and he wanted to set a good example for thousands of CSI employees who travel every month. That's a very good CEO who thinks of the shareholders. That's fantastic. So what he wants is to reduce his salary to zero. He's going to pay for his own expenses. He says, I'm getting older and wealthier and find that I'm willing to trade more of my own cash for comfort, convenience, and speed. So you're going to start seeing him at the front of the plane instead of the back of the plane. And also, it looks like he's going to stay as the CEO until the board says that, he's no longer of value to the company. The only downside to that is going to be who's going to take charge. And if that person who's going to take charge, is he going to run the business the same way Mark Leonard did? I think that's going to be the big key component to this company, because they have such strict criteria for purchasing and picking up certain businesses, that hopefully whoever takes over maintains that certain criteria. And as we can see, once we get to the financials, I think that's going to be a solid business model, and I think they're going to make a lot of money for shareholders in the future. So those of you that are subscribed to Seeking Alpha and can see news articles written by certain authors, check out this news article under the CSU. This guy, Tomas Riba, check out his news article that he wrote on this company. It's a very long, very in-depth news article on CSU. I think it was very well written, very well done. I learned a lot from reading just this one article here. And when you do read it, make sure you follow and like his article for all of his efforts that he put into doing this news article. All right, so financials on CSU. We have our revenue, gross profit right here, growing exponentially, just taking off. Our net income kind of just chopping around relatively flat, but we can see our SG&A here is a big cost of our total revenues. 4.6 billion, and gross profit, I should say. $4.6 billion out of our $6.6 billion gross profit, that leaves us with about $2 billion. And obviously you have other operating expenses as well. So that leaves you with $547 million in net income currently. Gross margin sitting at 88.3%, net margin 4.1%. Revenue, gross profit, year-over-year change maintains above 10% growth rate so far. I mean, 13.4%. I mean, it's seen 10% once, otherwise it stayed above 10% for the last 8 years now. So pretty good track record of growth. Return on invested capital, 6.83%, but they are basically using all of their free cash flow to acquire more businesses. So the return on invested capital isn't tomorrow or the next day. It takes time. So they're investing so much of their money that it's going to take time for this return on invested capital to start catching back up to where it was in the 30% range, which I think it will. $2 billion worth of businesses a year. And, it's going to take a little bit of time to see a return on invested capital on some of these here. But PE ratio sitting at 39.43, so it's the lowest it's ever been. Well, almost, but it's in the lower range. So could tell you that maybe it's kind of undervalued, but we'll have to wait and see. Cash to short-term debt. Got a lot of short-term debt to cash. Cash to debt, we have quite a bit of long-term liabilities compared to cash. Net income to free cash flow. Not a lot of net income, but a lot of free cash flow. And we will go through the most recent earnings released and break down the cash flows and cash to debt. Share count dilution, not getting diluted whatsoever at the company. Free cash flow. And that's another thing the CEO has mentioned too, is like they don't pay out stock-based compensation. There's zero dilution to the shares, and there's never been dilution to the shares. Free cash flow. I mean, that just the business has just got a very good CEO with the shareholders in the front of their mind. They're always thinking the shareholders, which is probably the number one thing you want in a company, is a staff that's thinking of the shareholders. So we got our dividend here sitting about $4. It's been relatively flat. It hasn't really grown much, but that's about where it's sitting. Capital expenditure is very nominal, sitting at $41 million on a company that's doing $5 billion in revenue. So nothing to worry about there. If you guys are interested in the valuation spreadsheet, it is now available on Patreon, and I'll have a link to that in the description down below. Now I'll hop over here to the earnings release, and left-hand side, we've got the most recent, and right-hand side is year-over-year comparison. So current cash, 970 million. Total assets, total assets are actually down here, 9.1 billion. And it looks like they're holding all of their business purchases are held in intangibles at $5.7 billion. They do depreciate these over time, so you will see that obviously decline slightly. So if you're on the liabilities, whenever I go through liabilities, I always look to see if there is deferred revenues, and there is. They got $1.8 billion in deferred revs. I personally always usually get rid of those because it's just unearned income. So then I'll just eliminate that. So that leaves them with $3 billion in short-term debt. And then so you take 7.3 minus 1.8 gives them $5.5 billion in total liabilities. Still a lot more liabilities than what they have in cash. But they do have down here $1.54 billion in retained earnings, so they can utilize this to make more future acquisitions. So they got plenty of cash for retained earnings to buy more companies in the future, which is their business model. On the right-hand side is our 6 months column for revenue. And we can see in the last 6 months, we're up, 950 million or 908 million in just revenue. So pretty good growth in revenue. Big staff increase over here, which kind of threw away a lot of the revenue numbers. And so you come down here, you take 3.95, you got all your expenses, you're left with you deduct 3.469, you're left with $453 million. But then you got to deduct everything else out. Taxes, looks like they got deferred income tax expense and then more tax expenses, and you're left with negative $57 million in net income. Down here at the cash flows, $57 million net income. We got depreciation and amortization of intangible assets. So we get to add those back in. And then that gives us, after everything else gets added in, deducted, and all these other things, that gives us 755 million of CFO. Take 755 minus capex of 19 million. It gives us 736 million of free cash flow, or $1.45 billion annualized free cash flow. So pretty good free cash flow. So once we kind of go through those numbers a little more, the only, I guess, concerns is just the staff. If they can reduce their staff or maintain staff and increase revs, which I think is the purpose of the business. They're trying to find these companies that are going to grow, right? Obviously, you're not going to buy a company that's just going to be a horizontal. They're looking for vertical. So hopefully those revenues, which we can see, revenues have grown quite a bit year over year, or actually just in the last 6 months. So did staff, though, but that's probably potentially from some other acquisitions. So we also got to account for that. So these numbers could be accounting for they just acquired a business, but they haven't seen the revenues from that business, so it's going to be a liability before they even seen any revenue from it yet. So these numbers can be a little off sometimes. So, but regardless, pretty solid business model in my opinion. So over here at the calculator, Peter Lynch valuation, we got CSU. Gives them a Peter Lynch fair value of $1,394 per share. We're going to skip on over here to price to book. Price to book, 5-year average, 65.85. Price to book currently 78.13. PEG ratio, forward looking 1. And PEG ratio currently 2.15. Graham's valuation gives them $2,756. Dividend discount model, $2,821.15. Our DCF here, average growth rate on free cash flow is 20%. Analysts have 21. I matched analysts at 21%. That gives them a DCF price per share of $2,628.34. Rule 72. I've only found there's not a lot of analysts. There's only like one analyst so far well, not one, but there's very little analysts that are covering this company. So we found an average EPS growth rate on 2 sources for 28. So our average is 28. And so 28 goes into 72, 2.57 times. That then goes into 10 years, 3.89 times. So then we get to double our EPS 3 times and then 0.89 times. So this one's tough, but because of the lag, I'm going to adjust the future EPS because we're sitting at 50 and we're still going to grow that about 4x from where it's currently sitting, maybe. So that gives them a fair value today of $2,800 per share. So final valuation, we're currently trading at $2,781.31 per share. So we know where we're trading at. We're trading at $2,781 per share. We get a fair market value of $2,394.84, 30% margin of safety, $1,676.39. So now I've kind of given you guys the fair market value on this company. I mean, the spreadsheet's available for you guys to run it through with your own numbers if you'd like. But I believe that this is one of those that you really got to do a bit. You got to do your homework for sure. But based on the key points I gave you, I hope it was enough for you guys to understand and maybe help make a decision and maybe in the future this will make you a lot of money if you decide to purchase this company. But I would highly recommend doing a little more background research on it, learn more about the company, and see if this is something that really interests you. For me, it's really interesting to me, given thanks to the person that brought it to our attention, and now we get to share it to you guys, to the rest of us, and we all get the opportunity to maybe make this trade and add this to our future portfolio. And I think this is definitely one that should not be forgotten about or looked past. I think this is something that you should spend a little bit of time on and see if it's worth fitting in your portfolio. But that is it for CSU. Now, if this is a company that really interests you, leave it in the comments down below. I'd like to see more input from other people on this company. This one's really interesting to me. This was recommended to us by a current subscriber actually, and I don't know where he found it, but I'm glad he did because I'm very interested. I'm going to keep learning more about this current company. I think this thing's got some very big future potential behind it, honestly. And I try to do my best here to give you guys the key points of the business. I hope this works for you guys and you guys found value in this video. And if you did, drop a like, subscribe, and comment. And we'll be back later with another stock analysis video.